policymakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Markets await the Fed's final decision of the year. It's expected to hold for a third straight meeting while pushing back on speculation on when rate cuts will begin. Then the UK economy shrinks more than expected in October. That sets the stage for another quarter of stagnation that's forecast to linger through next year. Plus, COP28 breaks new ground. The climate talks in Dubai end with the first global commitment to transition away from fossil fuels. And, of course, the two big interviews of the day. We have two great guests coming up on the program. I'm looking forward to speaking to Mark Schneider, Nestlé Chief Executive, also for an exclusive conversation, Tal Cohen, Nasdaq Co President. That's in about 10 minutes, and then at 9:30. So a lot going on, not only when it comes to big guests on the Pulse, but also what the market is looking at. So let's get straight to European markets map to have an indication of what treasuries are doing and how that filters through to what some of these equities are telling us. Now, if you look at European equities, we're seeing small moves. Again, investors really awaiting for the Fed's latest decision this year. We did have some recent data in the U.S., and that's been reinforcing speculation that policymakers will be in no rush to actually claim victory against inflation just yet. Now, I'm looking at the FTSE. It's gaining some 0.4%. CAC 40 also similar gains across the board. The other things that we're watching out for, and I do think I saw a pound chart, so I think we'll get that up for you, but a lot of focus will be on the UK economy and the fact that we could look at stagnation going forward. So inflation's coming down, but with it also GDP forecasts. That could be a bit tricky for the Bank of England as we get into 2024. You can see sterling 125.28. So investors betting that the Fed will hold interest rates when it wraps up its final meeting of the year later today. Much of the focus will be on what the central bank says about any policy easing next year. Now, for more on all of this, we're joined by Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Kim, thank you for joining us. I mean, there's a lot going on. It's all about inflation. It's all about the Fed. And it's all about whether policymakers feel comfortable to start talking about cuts. It doesn't feel like that moment in time.
Yeah, I think it's a little early for that. So today the focus is going to be on the dot plot for the Fed, whether they show us 2 or 3 cuts for next year. It's a close call. It doesn't take too many participants to shift to that third cut. But we think probably they might try to stick to 2 just to end the year on a more broadly balanced tone rather than encourage further easing in financial conditions. And then, like you said, it's up to Powell how much he's going to push against that market pricing. I think he's going to want to be pretty balanced as well and stick to that message that we heard from him earlier, which is growing confidence in disinflation, but not quite there yet. It's still premature to talk about rate cuts.
I mean, the other thing that matters, I think, which maybe we don't talk about enough, is when we get cuts, if we get cuts next year, which is quite likely, is it for the right or the wrong reason? So the right reason is inflation comes down and you kind of track it with the inflation rate, rate cuts. But for the bad reason is that we could be looking at recession, potentially we could be already in one. So are you optimistic about the U.S. economy?
It's a good question. I think right now we're looking at the data. The labour market just isn't weakening fast enough to have that recession call come to fruition in the next few months. The payroll data that we saw, it's still around 200K on a 3-month moving average. The break-even rate there's more like 100 to 120. So to move into that recession narrative, you're going to have to see faster weakening in the labour market data.
So what does that mean for treasuries? I mean, overall, fixed income is kind of the place to be.
Yes, it's a good year, 2024 for bonds. I think taking one step back, up until very recently, the big question for the market was how high will we go? And that was a more difficult environment for bonds. Right now, the big question is when will they cut? And that's a much more conducive environment for bonds. So we think, maybe you get some retracement this week if central banks don't give us enough of a dovish impetus, and then the bond market hits a wall of supply in January. But bigger picture, there's still a lot more that the market can price, even if the Fed doesn't start as early as much to where they can eventually get to.
So, Kim, what do you think the market is mispricing right now? And again, there's a belief that we have cuts, but policymakers keep on saying, look, they're going to stay higher for longer. So maybe the market is overpricing too many cuts or too quickly.
Yeah, I think the risk from where the market is with about a 50% probability of the Fed cutting in March is that a still pretty healthy labour market pushes that out further in the year, despite the fact that we're going to get better news on disinflation.
The UK, I mean, the UK is also a case in point of, what the hell do they do, to use a technical term, given that inflation's coming down, but actually the economy is weakening.
Yeah, I think the Bank of England's in one of the trickiest spots. It's really hard. Like, we had the weaker GDP data. Maybe that was influenced a bit by one of the wettest Octobers on record. And then we had the wage growth earlier this week, which was softer. But I think we need to be cognizant of the headwinds to inflation that the UK is still going to see going into next year. We've got one of the most prominent indexation issues, which will bias inflation up, or at least keep it stickier than other countries at the turn of the fiscal year. You've got the national living wage, 10% rise, that's going to feed through to the wage data next year as well. And then it's the uncertainty about where the labour market's actually at, data quality issues, and also fiscal versus monetary policy. Are they still going for the same objective? So difficult point for the Bank of England. I think it's too early for them to remove their conditional tightening bias. Yeah,
and I guess, again, I don't know whether Christmas spending makes a difference to understanding what the labour market could look like next year. Are there indicators, where you don't have to wait mid of next year to have an idea of what kind of economy we'll be left with?
Yeah, the Purchasing Manager Index, which is the leading indicator for business sentiment, will be close one to watch. I think 2 months ago in the UK, that was looking really soft, and maybe the economy was starting to roll over. But in the last 2 months, that's really picked up and kind of unwound almost all of that weakness. So that's the one that we're going to be watching going forward.
What does that mean for gilts? So when you look at, sterling and gilts, is there anything, do you trade it or look at it compared to, for example, European bonds such as like BTPs or German bunds?
Yeah, I think the cross-country call's a bit hard at the moment. It almost feels like we're at like a really good buffet. You've got so many options and spoiled for choice. But I think the picture in Europe is maybe clearer in terms of the softer growth, softer inflation. The biggest news we probably got in the last few weeks was from Europe, just that speed of disinflation, which the ECB is going to have to address tomorrow.
And then I think we have finally some agreement on the German budget. Was it something that you were looking at to kind of decide, what that meant for German bonds?
Near term, not the biggest driver. It's still going to be what Lagarde pushes back on market pricing tomorrow. It was interesting that Schneider had a big shift on the latest disinflation data, going from the last mile of disinflation being the hardest to ruling out further rate hikes. So how much is Lagarde going to echo that same message or stay more neutral, I think is going to be the bigger impetus for bonds.
Kim, thank you so much for joining us today. Kim Crawford, our Global Rates Portfolio Manager at JPMorgan Asset Management. Now, coming up, the co-president of Nasdaq on the exchange's biggest ever deal. We'll discuss the IPO market heading into 2024. This is Bloomberg. So Nasdaq has recently finished its biggest ever acquisition, adding software provider Adena for $10.5 billion. Now, it's part of a strategic move by the U.S. tech exchange to help it transform from a trading and markets firm into financial technology. So let's discuss all of this with Nasdaq Co President Tal Cohen. Tal, great to see you, and thank you. You're in London, which is extremely exciting. So tell me about this big acquisition. How's it going?
Yeah, so thank you for having me this morning. This is a transformational opportunity for NASDAQ as we can become and solidify our place as a strategic partner to our clients, given the capabilities we're bringing on with Adena, where we're going to be a market leader in helping our clients solve their toughest operational challenges across risk, regulation, and trade management, and also puts us one step closer to the ambition that we have to be the trusted fabric of the world's financial markets.
So talk to me a little bit concretely. Have you folded in, for example, the teams and technology into NASDAQ, or will that take a little bit longer?
So we closed the transaction on November 1st.
Yep.
We hit the ground running. We're going through integration right now. And we are starting to fold the teams together, integrate, and make sure that we're driving alignment. And we made an announcement about what that team's going to look like. Yeah. And now we're talking to customers about what we can do for them.
So when do you see the benefits of the acquisition? When do you start actually seeing returns?
Oh, we're already starting to see a few of the benefits. Clients are already approaching us about what more we can do for them on the risk, the reg tech, and trade management side, because we complement each other so well.
So how will you use AI to actually transform the business? Again, do you have any concrete cases that would explain to our viewers how it will transform your business, but also what clients can do?
Yeah, we've made investments over the last few years that have really helped us unleash the power of AI. We've embraced our data management platform. We've embraced the cloud. We have a really strong posture on information security, and we put a governance structure in place to make sure that we do it safely and responsibly. And now we have over 20 products that are either powered or enabled by AI across all of our different markets. One great example is we have an AI-assisted fraud detections where human analysts can now use Gen AI and a large language model to really automate all manual tasks so they can focus on higher value activity and truncate the time for each investigation. It's a great example of how we're using AI to fight financial crime.
So, Tal, Nasdaq also, I think at some point planned to launch a crypto custody business, but you abandoned the strategy. Are you completely out of it, or is it something that could come back?
We've been really disciplined from the start in terms of capital allocation into crypto and digital assets. We have not made any major acquisitions. That custody platform that you just talked about, we're still going to launch it, but we're going to launch it as a technology service. So we're going to have an institutional grade, end-to-end technology platform that we hope powers not only digital assets, but markets like carbon, where we can increase adoption and maturation of those markets through this technology.
But is there something that needs to happen with regulation for you, I guess, to become much bigger in the digital asset marketplace?
Well, regulation is still the big unlock, and there's a few unlocks there. Regulation, clarity in the U.S. in particular, but also institutional adoption. It's been a little slower over the last year and a half as interest has waned because of some of the events in crypto and digital. But we're using the DLT and the blockchain technology to power other markets, like I said, like carbon. We have an opportunity to do that with tokenization on hard assets. We just announced a deal with Chile as well.
Okay.
So that's been our focus.
Tal, I know the SEC has also put some market restructuring proposals in place, or market structure proposals in place. If you look at the regulatory space, like, what worries you the most?
The amount of regulation, the pace and intensity of regulation. Right now, you have it both on the banking side, which folks aren't appreciating. You have liquidity and capital rules from Basel III Endgame, Basel IV. And then on the capital market side, you have market reforms, and you have this move to T+1 in the U.S. markets. So I think the combination of all that is putting a lot of pressure on banks, and it's increasing the operational complexity of running these large institutions.
So it's really the amount of regulation. It's not one specific. Are you expecting more regulation to come in 2024?
Yeah, and it's really the confluence of all that regulation happening at the same time, and the banks trying to resource that and understand how they navigate that. And I think this is going to be an ongoing thing. We just did a survey of our clients, banks, brokers, and market operators. Their number one concern, 64% of the respondents said, it is regulation.
I also want to talk to you about IPOs, which I know is a small part, but actually if you're sitting in London, you managed to grab a lot of the companies that maybe politicians and policymakers would like to list here. We also understand that there's going to be more of these listed companies going to the U.S. What do you think is driving that?
Well, let's talk about Europe for a second and what's happening in Europe. It's a great question. It's not homogeneous in Europe because our Nordic franchise in Sweden, we have a great SME listings market. It's first class because of the retail participation and the pensions that are driving it and the government that's supporting it. But more broadly in Europe, I think you're facing structural issues around tax regime, onerous regulation, a lot of fragmentation and complexity. And then on the Nasdaq side, and we love our listings franchise, by the way, we have a great listings franchise, deep pool of liquidity. You have the Nasdaq 100 family of indices. We are really taking a leadership position in ESG, helping issuers understand that. So we have this great day one experience, and then we have all these other corporate solutions we provide.
So what do ESG issuers need more of? I mean, I guess clarity, possibly a carbon market. I don't know. I mean, why is it taking so long?
And so on ESG and issuers, they're just trying to understand the disclosure and the reporting needs. Yeah. It's really difficult if you're an issuer to understand what investors are looking for. So we're providing advisory services, trying to explain to them, this is what issuers are looking for, this is where governments are going. And governments aren't really coordinated on their view on ESG, which is making it even more difficult on issuers.
So as we go forward, listings will be how much of your overall business?
Listing is foundational.
Yeah.
It drives a lot of activity on the exchange side, as you know, and we're going to continue to invest in our listings franchise. It's a premier franchise. We just actually renovated our market site location, so that tells you a little bit of how we think about our listings franchise. We won, as you noted, ARM this year, CART this year. Yeah, so some of those, that's right, some of those issuers are looking at the U.S. markets, the liquidity that we have, the investor base we have, and the health of the capital markets there.
Do you feel field angry calls from UK politicians?
Not yet. Not yet. I'm hoping not to get them. But we want to also help Europe. So to be really clear, we have a big franchise in Europe. We're willing to take that call and talk to them about how we can help in Europe.
What do you worry about the most in 2024? You have a lot of exciting things on your plate.
Yeah, so there's a confluence of events that I'm keeping an eye on. One is we're always thinking about cybersecurity. As we have 2 wars going on, we have to make sure that we're running our markets, which is critical infrastructure, and make sure they're well-functioning and resilient. So that's one. 2 is we want to put AI to work responsibly and safely. So there's a lot of effort to make sure that we're doing that. And then 3rd is, we got the Fed in focus. We got to see what kind of uncertainty and volatility comes. We have a couple of elections that are noteworthy in 2024. So we're just preparing the team to make sure that we're there for markets when they need us most.
I like that. A couple of elections. Probably the understatement of the year. You're so British. Thank you so much for joining us.
Thanks for having me.
The Nasdaq Co President, Tal Cohen, with the very latest on, well, everything really, the acquisition and some of the pitfalls that he sees ahead. Coming up, the COP28 climate talks in Dubai have ended in a deal on shifting away from fossil fuels for the first time ever. Yes, we're live in Dubai as the summit comes to a close. This is Bloomberg. Now to COP28, where climate talks have ended in a deal. For the first time ever, the agreement commits to a global transition away from all fossil fuels.
We have given it a robust action plan to keep 1.5 within reach. It is built on common ground. It is strengthened by full inclusivity, and it is reinforced by collaboration. It is an enhanced, balanced, but make no mistake, historic package to accelerate climate action. It is the UAE consensus.
Well, joining us now is Bloomberg's Laura Milan, live from COP28 in Dubai. So, Laura, how does this agreement actually balance U.S. and European needs against those that oppose any fossil fuel targets?
So it's fair to say that this agreement doesn't satisfy 100% everyone, and that's usually the recipe for a balanced deal. That said, the mood in the room is quite positive right now. We have seen the EU and the US highlight that the deal doesn't go far enough in phasing out all fossil fuels. The language is a bit softer than that. They had to give up on some of that ambition. But on the other side, we have just heard a few minutes ago Saudi Arabia representatives say they are quite happy with the agreement. Some of the things in there that make the Saudis and other fossil fuel producing countries happy is the mention of carbon capture technology as a way to reduce emissions, as a strategy to reduce emissions, and also the idea that not all countries have the same responsibility to phase out or to reduce the use of fossil fuels at the same speed.
So what does this mean in real terms? How does this change the field of play, for example, for investors, but also consumers?
Some of the analysts that we have talked to highlight that this is actually one of the most concrete deals that the COP process has approved so far. We have real-world practical things in there, like a commitment to triple renewable energy by the end of this decade, a commitment to double energy efficiency, and we also have mentions to electric vehicles and other technologies. So after the deal, now that the deal is approved, countries will have to go back to the drawing board and design ways to reduce emissions that include these very specific technologies.
Laura, thank you so much. Laura Melander, live from COP28 in Dubai. Now, also making news, governments across Southeast Asia are bringing back measures to limit a resurgence of respiratory diseases as Singapore, Malaysia and Indonesia all report an increase in COVID cases. The measures include temperature scanners at airports and mask wearing. The U.S. CDC has warned of the transmissibility of COVID variant named JN1, a strain that is accounting for about 60% of current cases in Singapore. Now, Bloomberg has also learned that SpaceX is to sell insider shares at $97 apiece in a tender offer, a price increase boosting the value of the space and satellite company closer to $180 billion. Now, the offer at the world's second most valuable, closely held startup is set to be in the range of $500 to $750 million. The rising valuation is indicative of strong investor demand for the dominant space transportation company. Now, Bloomberg understands that X, formerly known as Twitter, is on track to bring in roughly $2.5 billion in advertising revenue in 2023. Last year saw $1 billion coming in per quarter from advertising. The first 3 quarters this year brought just about $600 million in each quarter, while ad sales currently make up 70 to 75% of X's total revenue. Coming up, the exclusive interview of the day will be joined by Mark Schneider. The Nestlé chief executive will discuss the challenges but also the opportunities in the food and beverage industry. We'll talk about the outlook for next year. That conversation is up next, and this is Bloomberg. Now, markets await the Fed's final decision of the year. It's expected to hold for a third straight meeting, while pushing back on speculation on when rate cuts will begin. The UK economy shrinks more than expected in October, setting the stage for another quarter of stagnation that's forecast to linger through next year. Plus, COP28 breaks new ground. The climate talks in Dubai end up with the first global commitment to transition away from fossil fuels. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, from cost pressures to a slowing world economy, the impact of climate change to new lifestyle trends, the food and beverage industry is really facing a number of headwinds. There are challenges that the world's biggest food and beverage producer, Nestlé, is also grappling with. Now, shares down about 6% over the past 3 months. There are also worries from investors that a new class of weight loss drugs could threaten profit. On the positives, there's innovation and, I guess, things to sell all over the world. Well, joining us now for an exclusive conversation is Mark Schneider, the chief executive of Nestlé. Mark, thank you so much, and also thank you for coming in our London studio. I mean, I could speak to you about 3 hours because you really have a microcosm at your hands of trying to understand what the world economy is doing, what people are spending on, what they don't. First of all, how's inflation going?
Well, look, we're coming out of a pretty historic 2-year inflation spike. When you look back for historic precedents, it's not till the 1970s, so literally a 50-year event. And the spiking is over, but you still see somewhat elevated inflation levels. It's too early to call deflation. And so after these 2 years, it's understandable that consumers have some trouble making ends meet. Yeah. There's caution out there. You also see that central banks have done what they're supposed to do, and that is fight inflation. And so that is now making its way into the real economy. You see mortgage rates going up. You see leases and rents going up. And so all of that adds up to a good deal of consumer caution.
But overall, Mark, how has Nestlé actually changed under your watch? I don't know whether there's been more or less. For example, ad spend. I know you've readjusted also the focuses and the key markets you want to be in.
Yeah. So I think the key item over the last 5-6 years internally was cranking up the rate of innovation and clearly making sure that for an industry-leading R&D budget, we're getting a steady flow of new and exciting products, because that is ultimately what drives mix and what drives revenue growth from a real internal growth point of view. And then on the external side, we've done a lot of portfolio rotation, about 22% over 6 years. Deal volume of about $50 billion with good acquisition outcomes, but remarkably also walking away from potentially $50 billion worth of deals when prices seem to be too high. So a good amount of deal discipline at the same time.
How much transformational deals do you think you'll do in the next 2 to 3 years? I know one of the big questions is, for example, margins in water, which is also, they're lower than the rest of the group, and they're not that sustainable or climate friendly. Is that something that you'd get rid of?
Yeah. So we made it clear that the bolus of some of that portfolio rotation is done, but clearly on a large book of business that's approximately 100 billion Swiss francs, you constantly have some portfolio rotation. You're trading into very promising areas. And when you see longer-term limitations to a category, then you have to ask yourself the question, are you the best owner? Is it the best fit? And so specifically, I have no announcements to make today, but clearly, that process of evaluating opportunities either to grow or to divest will continue.
So I know geographically, for example, you've said in the past that you want to be very present in India.
Yeah.
Or can we expect something big in India because of consumer demands and actually the wealth of citizens is growing?
So India is a super exciting market. We even held a board meeting there last year to see on the ground all the dynamism. We're super impressed with the move towards digital. So clearly that to me is the biggest change from pre-COVID years to post-COVID years, how that economy has fully digitalized and taking all the benefits that come from that. So clearly we're growing there very consistently with above par growth rates. Would be very happy to build on that with additional acquisitions. But obviously we also have to look out for value and have to look out for valuations that make sense for us.
I mean, what do valuations look like right now? Again, because of inflation, I don't know whether it means that maybe in the next 6 to 8 months it's easier to find good deals or whether it just makes it tricky because of all of the unknowns.
So generally from their peak in late 21, valuations have come down somewhat. But you see that some people, especially those who don't need cash immediately, are still holding out, and there's a hope that maybe the Goldilocks years will return. I think it takes a bit more time for the newer realism to sink in, and what you saw us do is act with quite a bit of caution here when it comes to deal-making activity in 22 and 23, and I think that was the right call.
Yeah, I mean, again, there's quite a lot of volatility. We touched on inflation. There's political upheaval. Like, overall, what do you worry about the most?
So clearly, it's going to be staying a very turbulent environment. We'll need to see how the economy continues and what that means for consumer sentiment, especially during the winter. And then also between the business strategies and geopolitical risks to be sure that we navigate in a way that we can live up to what we want, and that is stable, dependable growth.
So what are you optimistic about? Again, I don't know whether the holiday season in certainly the Northern Hemisphere is a good test of actually consumer robustness going into 2024.
Yeah. So what I'm most excited about is the fact that we have a portfolio now after a lot of adjustments that's geared for very dependable, successful growth. We've had lots of gyrations here due to COVID and in-home consumption, out-of-home consumption. And so looking beyond the short-term consumer caution, I think it's more important to see 24, 25, looking ahead, what are the underlying strengths here that this portfolio has to offer?
But again, so given the numbers that we have now, so what kind of trends will you see going forward? Now you have the health business, which is vitamins, and I don't know whether that takes a hit because of recession or that stays strong as people maybe go out less and take more care of themselves. Yeah. You also have a huge pet business.
Yeah. So pet continues to just steamroll ahead. So what we've seen there is a step up in pet adoption during the COVID years. It is not growing at double digit maybe anymore, but still, nonetheless, it's one of our highest growing categories, and it had 3 stellar years behind it and will continue to be one of our hallmark categories. On vitamins, minerals, and supplements, we did have a bit of a COVID or post-COVID hangover in 22. As you can imagine, during the COVID time, people were trying to boost their immune systems to the health, and now that had moderated somewhat. Yeah. That came to an end spring, summer, and then we saw demand coming up again. So there, going forward, we also expect very successful mid to high single-digit rates. Short term, we are marred by an integration issue that we called out to our investors in October. But once that is fixed, starting from 24, we should see that underlying growth coming through. So
were you able to actually increase prices and have higher margins? I imagine pet food is one of them, as people are willing to spend more for their pets.
Yeah. So we had to increase prices to reflect inflation on our input costs. As you know, it's also important for us to pay fair prices to our suppliers and the farmers in particular. But as you also know, our gross margin reduced a little bit because we were very much tuned into this idea of fair pricing and being sure that we're not fueling inflation. So whatever increases you're seeing in pet food are more due to meaningful innovation. So basically premiumizing the products, and this is one of the long-term growth drivers in the pet food industry.
Right. How much do you spend on innovation? Does the budget just keep on growing every year as you need to make sure that you're cutting edge at all times? Okay.
Yeah, so innovation is a key growth driver, and we have an industry-leading budget there of about 1.7 billion Swiss francs. Okay. And more importantly, making sure that that translates then into short cycle times from concept to shelf, and a steady flow in each category. That's important. I spent a lot of time with our head of R&D sampling products personally, spending time with the team, because clearly I want to be sure that they understand, everyone understands in their group, that their function is vital to ensuring future growth.
Okay, what's the most exciting thing you've tried? Or is that secret? The prototype.
The prototyping is always secret, but obviously we have very exciting developments underway when it comes to plant-based food. Coffee is a constant source of innovation, so there you see a never-ending expanding universe when it comes to new varieties and new trends. And then, as you mentioned, pet food is the other big one, where clearly consumers are yearning for premiumization, and we're happy to dish it up.
So, Mark, when it comes to plant-based food, is this? I mean, this has been the trend for quite some time. I guess eating also less sugar, less, just being more healthy in general.
Yes.
Does that go up on a trend or up and down?
Look, I think short term you have ripples and you have fluctuations, especially now when it comes to purchasing power, when it comes to some of the COVID limitations and the inflation spike. Longer term, the trend towards more plant-based nutrition is unbroken, and I would not define it narrowly as a look-alike burger or a piece of chicken or something. It is more about dialing up plant-based proteins as a source of your nutrition. And there, across the full spectrum, at every price point in every location in the world, we have very exciting developments underway.
Okay, so interesting. What's the one thing you can't live without, Mark, out of all of your products?
That's an easy one. It's an espresso. Clearly, I've been a 20-year customer and looking forward to the next 20 years.
Yeah, I think I have an espresso actually behind me.
Behind you.
I'm like, 50 human, 50 coffee, so I could probably agree with that. We'll continue the conversation with Mark Schneider, the Nestlé Chief Executive. He stays with us, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London, powered, you see, by coffee, espresso there. Mark Schneider, the Nestlé Chief Executive, is still with us for an exclusive conversation. Mark, we're joking around that we're both powered by coffee in general. You, Nestlé coffee, me, anything really. Talk to me a little bit about, we're talking about premium brands, about the fact that I guess you have to be careful at, making sure that you don't go up too much in prices because people can't afford it, but also this trend towards optimization and premiumization. Where do you see the strongest markets region by region?
Yeah. So look, we're committed to brands at all price points and levels of affordability. So it's not like premiumization is exclusively taking over. But yes, over a 10, 15-year period, we have been quite successful in premiumizing some of our brands where consumers were open to that. And we see lots of runway for that going forward. Yeah. Clearly, the most advanced markets in the U.S., in Western Europe, and also in Asia are the ones that tend to be the front runners here. And then you see that around the globe, everyone is getting very interested. And of course, these days, through digital media, whatever is cool out in the West Coast or New York gets emulated elsewhere really, really fast.
But in terms of numbers or consumption, do you see a bit of softness in Europe, Central Europe, but also the UK?
I think the premium side usually holds up quite well. There's a bit of trading down. It's more like at the mid-range of midpoint of the price range, where you see now some people more trading down to either cheaper brands or the private label, or also there's a reluctance to consume in the first place. So we saw, for example, in the U.S. With the running out of some of the SNAP food benefits in Q2 and Q3, that led to some hesitance. Now, it's a one-time thing. It'll lap out of the system next summer, but, those are some of the trends we're watching.
But so do you think that people tend to buy less but higher quality when interest rates go up and therefore they feel a little bit squeezed?
Well, that may be one trend. And look, that may be a good thing because generally our whole strategy is towards higher value, either nutritional value or premiumization, and be prepared for lower calorie future. So actually that's something that's right up and backed up by our nutrition, health and wellness strategy.
Mark, one of your main competitors was in a spot of trouble this week because of labeling of ESG products on recycling that, some of the regulators here was maybe not the case. How do you deal with potential greenwashing in your industry and at Nestlé?
Yeah. So I think we've made some very early efforts to make sure we live up to our vision, and that is to have none of our packaging end up as landfill or littering out there. And we're making very, very steady progress when it comes to reducing the amount of virgin plastics and reducing the size of packaging in the first place, and also advancing design for recycling. These are very challenging technologies. You know, the devil is in the detail, literally, especially in our industry, because for food-grade packaging, you're so much more limited on what you can do. And obviously, you know, some things work, others don't. We try to communicate as truthfully as we can. We're super transparent. We're publishing lots of data points around our progress around this, and want to be sure that consumers do have good sources of information coming right from our company.
But how difficult, again, you know, how difficult to get a handle on the supply chain? You have very long supply chains,
yes.
And so something can always go wrong, or there could be a mislabeling or something that you're not quite aware happening.
Yeah, and look, this is a developing area, and I think what the public should take away is we're really sincere in our efforts here, and we've done this now for a number of years, and we're having good progress to report. Occasionally, some things don't work as fast as originally anticipated, and we're quite open about that. And occasionally, look, especially in a fluid situation with long and complicated supply chains, something may sort of change, and then obviously it's important that people trust us and that they trust us being transparent about this and communicating the right things.
Right. I know there's always been quite a lot of speculation on what you do with the ice cream business or some other things that are IPO'd or spun off. Like, or you know, can we expect something of that magnitude in the next 12 months?
So clearly we've had fantastic success with our ice cream joint venture called Froneri, where we partnered with a private equity firm, and we've taken this now to one of the leading ice cream companies in the world, and very excited about it developing going forward. At this point, no announcement to make, but couldn't be happier with how this develops.
Yeah, given the trends that we've seen over the last, I guess, 4 to 5 years, which we've talked about, which is, you know, more nutrition, I guess, watching what you eat, more plant-based, are tastes changing? Like, how much focus do you put on trying to understand just physically how human behavior and human tastes will be in 3-4 years?
Well, obviously, this is a core area of our research. There's some general trends. There's also medical insights. And then, of course, there's lots of regional preferences. But one of the medical ones these days, of course, is the advent of GLP-1 drugs and what that means. Here, I see it's not so much a threat for us. It's more like a full-blown vindication of the strategy that we've been pursuing very patiently over the years. Take our high-growth categories that are not impacted by GLP-1, pet care, coffee, and our Nestlé Health Science business. That used to be 30% of our business in 2016. It is now about 50% of our business. So clearly, this is where portfolio rotation prepared us for this lower-calorie, higher-value future that we've been pursuing. So it's not impacting us.
I know a couple of years ago we talked a lot about some of the local players, for example, in India and others, like local brands that became massive that people preferred in certain emerging markets. Is that still the case? Again, is this one of a threat maybe that you're looking at?
Yeah. So we're seeing very successful local brands. We're seeing very successful global brands. And to me, it's not so much about local versus global. It's about strong versus weak. And so clearly, if a local brand is meaningful, we'll drive it. We have a stable of about 2,000 brands around the world. If a brand is global, obviously, you know, that is a core asset. We have more than 30 billionaire brands, and those are growing above par.
Mark, thank you so much. What a fun conversation. I could talk to you for another 3 hours.
Same
just talking
here.
about
Same
food and health. Mark Schneider, they're the Nestlé Chief Executive Officer. Now, coming up, Argentina devalues the peso by over 50% as newly sworn-in President Javier Milei launches his economic shock therapy program. So we'll have plenty more on that next. And this is Bloomberg. Now let's bring you some of the stories hitting the terminal this morning. And Germany's ruling coalition has sealed an agreement on a revised 2024 budget. The revised plan hopes to settle the constitutional chaos triggered by last month's court's judgment limiting the use of off-budget funds. Now the Chancellor Olaf Scholz, Economy Minister Robert Habeck, and the Finance Minister Christian Lindner will brief reporters on the details of the deal at 11 a.m. UK time. The United Nations General Assembly has voted overwhelmingly to demand a ceasefire in the Gaza Strip. It marks a shift in sentiment, with U.S. President Joe Biden warning that the Israeli Prime Minister Benjamin Netanyahu risks losing global support unless he changes his views on a two-state solution. And Hungary says it is prepared to lift its veto on a massive EU funding proposal for Kyiv in return for €30 billion in financing. Now, the EU has been withholding the funds from Budapest since last year as a result of democratic backsliding. Meanwhile, Volodymyr Zelensky has left Washington with no clear commitment from the US that it will maintain financial support for Ukraine. Congress does not look likely to approve the $61 billion of aid Ukraine requested, but President Joe Biden vowed the U.S. would come through. And Argentina has devalued the peso by 54%, overhauling its crawling peg, and announced massive spending cuts. Now, the newly sworn-in President Javier Milei has promised to rescue the nation's economy with a shock therapy program. For more on this, we're joined by Ziad Daoud. He is Bloomberg's chief emerging markets economist. Ziad, so good to speak to you. So can you tell us a little bit more about these recent moves and actually how the market reacted to them?
So Argentina moved on two dimensions, Francine. It moved on the currency. It devalued the currency by 54%. The current official rate is still below the parallel rate. So they also said that the currency would weaken by 2% a month. And they also moved on the fiscal side. So on the fiscal side, Argentina has slashed spending, is cutting spending to pensions, it's cutting subsidies, it's halving the number of ministries, and is planning to increase the tax intake. So overall, Argentina is trying to fix its foreign exchange market, is trying to reduce its budget deficit, which is the root of all of its problems. But these two measures will come at a cost, and the cost is on growth. So our team expects Argentina to contract next year, and that's on the back of an expected contraction this year. So 2 years of negative growth in Argentina, that's the cost of fixing the foreign exchange market and fixing the budget deficit.
So, Ziad, President Milei has also pledged more drastic steps in his election campaign, dollarizing the economy, abolishing the central bank. I mean, are these coming next, or is that wishful thinking on his part?
Not imminently, Francine. So Argentina doesn't have enough dollars to dollarize the economy, which is basically replacing all pesos in circulation with dollars. Our economist, Adriano De Pita, estimates that if that happens, if Argentina were to do that today, then basically you're going to have a massive reduction in the value of the peso. And basically, if you think contraction and recession is bad, imminent dollarization would basically cause a depression in Argentina. But we don't think that the idea is completely off the shelf. We think that the president is basically postponing rather than abandoning the idea. He thinks that dollarization would fix Argentina's inflation problem once and for all. He thinks it will limit the central bank's ability to fund the government's budget deficit. And he thinks that would basically end Argentina's budget problems once and for all. So it's not imminently, but it's not completely off the table yet.
Ziad, thank you so much. As always, Ziad Daoud there, Bloomberg's chief emerging markets economist. And, of course, Europe's biggest money manager, Amundi, is also counting on Javier Milei's shock therapy and Donald Trump's return to pay off big for bond investors in Ukraine and Argentina in a bet that right-wing populism will actually determine the most compelling stories in emerging markets next year. So we'll have a full, of course, roundup of some of these top news shortly. This is Bloomberg.